Welcome everyone. Welcome back to the Wealth Lounge. I have here with me, as always, a special guest. We have our sales manager and senior loan originator, Mr. Chris Fratta. How you doing, man?
Doing great, Ryan. Thanks for having me on.
Absolutely. Thanks for joining me. One of the things that gets confusing about mortgages, there's so many different types. But we're going to talk about two different types today and shed some light on what might fit your specific needs. So today's topic is going to be the differences between a fixed rate and a adjustable rate mortgage. Now, Chris, I know you've had over 20 years in this business.
Almost 30.
30 years in this business.
Almost 30.
Wow.
So I don't have any hair.
Well, I tell you what. I mean, if there's anyone that I feel would know these this topic, it would be you. Okay. So why don't you shed some light on the differences between an adjustable rate and a fixed rate mortgage?
So the biggest difference is obviously in the name, fixed versus adjustable. Mm-hmm. Fixed interest rate, fixed mortgage program is going to provide that borrower a fixed rate, so that rate's not going to increase or decrease over the life of the loan. And what that means to the borrower is that principal and interest payment is not going to change as well. So even if the markets start to turn a little bit, to the bad side, that payment is going to be fixed from the first payment to the final payment of that mortgage. Mm-hmm. The advantage of that is it allows that borrower to set a budget every single month. They know the money that's going to be coming in, and they know the exact money that's going to be going out with their mortgage. So it allows them to really kind of forecast what their cash flow is going to look like in January, as well as what it's going to be in December.
Yeah, that is a strength moving into something like that over the course of 30 years. You mentioned that one of the benefits was that payment remains the same.
Correct.
Throughout the duration of the mortgage. Mm-hmm. But what are some other advantages for a fixed rate mortgage?
I mean, a fixed rate is basically going to, especially if you're a first-time home buyer, and you're new to managing a debt as large as a mortgage. Mm-hmm. You know every month you're going to get X amount of dollars on the 15th and the 30th of the month as far as pay. And on the first of every month, you've got the same payment that's going to be required to pay month in and month out. Mm-hmm. So there's no surprises that anyone's going to find. It's not as if 1 month their mortgage payment might be $1,000 a month, and then as could be the case with an adjustable mortgage, if it adjusts up and the market is really kind of off, that mortgage could jump by a couple $100. Yeah. So it allows that first-time home buyer, or even that fixed buyer, or that move-up buyer, to manage their money because they know what their cost is going to be month in and month out. Mm-hmm. There's no questions, there's no changes.
Yeah, that's actually really good to know. I heard you mention that in an adjustable rate mortgage, mm-hmm. that payment can kind of jump up on a couple $100. But what are some advantages to an adjustable rate mortgage?
So an adjustable rate mortgage is what it says, adjustable. So you have an interest rate which is tied to what's called an index. And that index is going to determine where that rate is going to go. So you have an index, you have a margin, then you have the final interest rate. Mm-hmm. So the way we determine what that interest rate is going to be is whatever that index is that we're going to use, whether it be a 1-year T-bill or 10-year, you've got your index and then there's a margin. And that margin can be anywhere from 1.5% to 2.5%. And that margin will be added to that index, which will create what's called a fully indexed mortgage rate. And that is the borrower's rate for that term. And that adjustable rate can be fixed for 12 months at a time. There are some rates that will be adjusted for longer, maybe 3 years or 5 years. And then it will convert to an adjustable rate after that initial locked-in period. So the advantage of an adjustable rate, especially for someone who, let's say they're entering the workforce and they're starting the salary X, but they understand that they're in a company that's going to allow them for growth opportunities and income increase opportunities. Well, an adjustable mortgage allows that individual to kind of get their feet wet first, allows them to kind of get in at a lower payment than what would be that final capped-in payment that, say, a fixed interest rate would be. Mm-hmm. Because typically, your starting rate on an adjustable mortgage is an introductory rate, which is going to be lower than typically what your fixed interest rate will be. So it gives a little bit of flexibility as far as how much money you're going to pay every single month. So that's an advantage to the borrower, but they've got to know that there's a risk. And that risk is depending on what the markets do. If the market starts to rise and we start to get to that anniversary point of that adjustable rate, so let's say if someone closed on January 1, 2023, and they opted for an adjustable rate, That anniversary date will be January 1, 2024. If the markets are rising, there's a good chance that interest rate is going to increase as well, and then it'll be fixed again for another 12 months at a higher rate. However, the advantage of an adjustable rate, in addition to starting out with a lower payment and allowing that borrower to kind of ease into that mortgage budget, is that when the financial markets improve and there's an adjustment, that rate can adjust down as well too. So you could be potentially looking at a lower mortgage payment than what you started.
Oh man, that's really good to know. So I'm assuming that an adjustable rate mortgage, would be really, really strategic in the market that we're in right now.
Sure. I mean, and there are individuals who are risk averse, so they don't want to take on that responsibility, that risk of that mortgage payment potentially increasing over the life of the loan. And that doesn't make that buyer any different than someone who doesn't mind the risk. It's a matter of what's comfortable for that individual and for that individual's family. And the importance when we're talking to buyers, whether they're first-time home buyers or whether they're buying their second and third house, is when we do that consultation, we're discussing what works best for them today and also what works best for them down the road. Because we want to kind of forecast where their family's going to be, where that individual's going to be. Are you expecting potential raise increases? Are you expecting your family to grow in size? Is this house going to become too small or too big at any point soon? So when we talk about the programs and the qualifications of everybody, we're not just focusing on today. We want to really find something that's going to fit that individual, not just for today, but also for tomorrow.
Yeah, that really should provide some comfort for those of you who are kind of sitting on the fence. It's really good to know because there are mortgages there that would, serve the fear of a high interest rate in today's day and age. I mean, listen, the pros and the cons for an adjustable rate mortgage seem really clear. But in a fixed rate mortgage, it sounds like it's all good. Are there any cons to that style of mortgage?
The con of a fixed rate mortgage would be opposite of the advantage of an adjustable rate mortgage. So let's say you're fixed at 6.5%, and we see the market rally 2 years into your mortgage, and the average fixed rate drops to 5.5%. Well, the disadvantage, if you want to call it a disadvantage, is that your interest rate is going to be still at 6.5%. But the advantage of that is you still know what your payment is. And what kind of offsets that disadvantage is that there's always a refinance possibility with a fixed rate. So if you're fixed at 6.5% and then market rallies and we see a point or point and a quarter drop in rate, a refinance is a very simple process to kind of readjust your mortgage back down to that current market rate.
Really, really, really good to know. Guys, tap into this because in both styles and both routes of financing, it seems we have an answer for whatever fear you may have. And to know that in an adjustable rate, you can come in at a lower payment, and if that thing ticks up on you, there's still refinance options that are still available. And the same goes for a fixed rate mortgage. And I think that all of those things are really good to know when you're kind of contemplating on your fence at whether or not you should purchase in today's market or in the future market. But Chris, I
think real quick, I think it's important to note that the majority of the mortgages that are sold today are fixed rate mortgages, but there's still a large amount of adjustable rates mortgages that are being sold and being closed. And the reason being is everybody is different. This just isn't a cookie cutter situation. So again, whether you're talking a fixed interest rate, a short-term adjustable rate, a long-term adjustable rate, it really comes down to speaking with a mortgage professional and really kind of getting into what your position is today compared to what it may be tomorrow. And then at that point, we kind of craft the best options for that particular borrower.
Options are very good for fears. Options are very good for confusion, and options makes a comfortable, an anxious mind a little bit more comfortable where there are ripples in the market. Chris, I really appreciate you coming on and answering these questions. These are questions that that kind of serves uncertainties on a lot of folks' behalf. So I appreciate you taking the time to come out and speak with me.
No, it's important stuff. And again, you mentioned fears. One thing we don't forget, one thing I particularly do not forget, is however many times I do this a year, the average person is going to do this 3 or 4 times in their life. So they're not expected to really understand fully what's happening. So it's important whether you're working with myself or one of my team members at Benchmark or anybody else, that you work with somebody who understands what's driving the market, how the market is impacted by, global situations, and then really understanding what that borrower's financial position is. Because those fears are normal. You're supposed to be scared because you don't know about it. There's a lot of unknown.
Normal.
But work with someone who understands it, and then we'll guide you through the process, as best as we can. And we do it pretty well.
Yes, I can vouch for that. Chris Fratta, 30 years in the business, sales manager, senior loan originator. I'm Ryan Dunstan, your narrator in the Wealth Lounge. I appreciate you guys. I'll see you next time.